I'm really excited today. We're here with Carl Allen. Carl Allen is an entrepreneur, investor, and corporate deal maker with almost 3 decades of experience buying and selling businesses. He's enabled over 300 deals and done $47 billion of deals over the last 27 years. Just so everybody else kind of gets to know who you are and what you're up to in the world, can you start with kind of that origin story, what got you into this and what you
Sure.
do?
Sure. So I got into the mergers and acquisitions world a long time ago, actually. So 1992, I left university. My first degree was actually in engineering, but all my buddies had gone to work for investment banks. They weren't as smart as me, but they were earning a lot more money. So I took the switch and I went to work for Bank of America, which was a large American investment bank. So I got involved in mergers and acquisitions. I was doing deals with the likes of Boeing, IBM, latterly Microsoft. So had a lot of fun and kind of learned the hard way, how to do deals, how to find deals, how to structure deals, and learned the whole concept of, what is the leverage buyout, or how to buy a business and use other people's money to finance and structure the deal. So I left the banking world. I went to business school in Chicago, did an MBA, spent some time in private equity, and then we'd invested in a technology business, which we ended up selling to Hewlett Packard. And as part of that deal, I went to HP. I was an internal director of mergers and acquisitions, and I had a great time, had a lot of fun, flying all over the world, doing deals. We went out and bought a whole bunch of software and services companies. But then my world and my life completely changed 14 years ago to this day. So it's very apt that we're having this conversation. So 14 years ago to this day, I was in a boardroom in Moscow with HP, and we were buying a business. And at the time, my wife was 36 weeks pregnant with our son, Josh, and he was still cooking in the oven. We thought he had a bit more time to go. And I'm literally in this meeting trying to close this deal. It was a large deal. And my phone's like ringing like every 30 seconds. And it's my wife. So I thought, well, I better answer it. And she's in the back of the ambulance going to hospital. She'd gone into labor. Her waters had broke. So she said to me, I don't care what you're doing. You've got to get yourself back to the UK as fast as humanly possible, or you're going to miss your son being born. A seller that was highly motivated to exit, retirement, sickness, death, boredom, frustration, burnout, whatever reason. And then me riding in as a white knight and basically building a deal around what was valuable to them, which was legacy, trust, safeguarding, all those different things. And that's one of the biggest mistakes that a lot of business buyers make. They think it's all about the money.
But my question is, when you say when you do minimal due diligence, when they're going to do an all finance structure, do you put an unwind clause in your contract, or you just
I
know
don't.
that you can?
No, I don't actually. I don't. Although in your situation that you'd mentioned, then that would be a red flag. But like for me, I'm not signing any personal guarantees. I'm not raising any capital. For me to do a super quick deal, it's quicker for me to buy the business, then go in and do the due diligence. And then if I find something like nuclear, I'll either give it back, or if they're not prepared to take it back, then I'll just liquidate the business. But that's never happened to me ever. Typically, I'll always buy the legal entity because in most cases, it's more tax efficient for the seller to do a deal like that. And secondly, it's easier to raise capital when you can leverage the credit history of the legal entity. If you buy a house that you can do a quick remodel on it, to coin a real estate analogy, and do that super quick, you're adding a lot of value to the business quite quickly. That's kind of the perfect deal for me. So never a deal. It's got to have cash flow. It's got to have good systems and processes. Customers that love the business. Big growth opportunity. That's like the perfect deal for me. I'll hold on to a business for at least 2 years.
Okay.
So I'm not a business flipper where I'm in and out within 60 days. I want to be in the deal for absolutely at least 12 months, ideally 2 or 3 years. I'm I'm a partner in a business that I've owned for 7 years still. And it would take an astronomical multiple for me to sell that business. But then sometimes I'll get bored. I'll buy a business, I'll make some money out of it, and then I'll just get fed up with it. I'll end up giving it to management or I'll sell it. It's really interesting because, not every business that you look at is actually sellable. There are a couple of things for me that sellers fail to do before selling a business. And I wish there was more education on the sell side to get people in that kind of frame of mind. So there's only 3 different types of people that can buy a business. You've got individuals or people like me, small teams that are coming in and are buying the business. We don't really have any leverage. We don't have anything that we can bolt into per se, unless I'm bolting a business into another one in my portfolio. But we're offering that legacy-driven, safe pair of hands, employee protection strategy. Now, for a lot of sellers, that's what they want. Other sellers, they'll want to take a partial buyout, stay with the business for a few more years, have access to other working capital, and then get a second bite in the cherry if they sell later. So that means you have to sell to PE. That's the only way that you can do that strategy. And then strategy 3 is you don't care about the employees, you don't care about the legacy, you don't care what happens to the business. You want the highest valuation and you want as much as you can physically get at closing. So you've got to sell to a trade buyer, a competitor. Because as you know, a trade buyer can get lots and lots of synergies by acquiring another business. They can cross-sell products and services between the 2 customer bases. They can strip out tons and tons of cost. To find the perfect deal for you, it's only got to tick 3 boxes. Box number 1, it's a deal in your lane. You know the industry, you're passionate about it, you can add lots of value. Number 2, it's a distressed seller of a good business. And number 3, it's got cash flow. If it's got all those 3 things, those deals are really easy to close.
Can you give us a little detail? Like, are you familiar with the SBA loans and what the requirements are? Is there a certain credit score or experience level or anything?
Yeah, absolutely. So there's actually 6 ways to finance a leverage buyout. I'll tell you what they are very quickly, and then we'll dive into the SBA. So number 1, you can use surplus cash. So if the business has got more cash on its balance sheet than it needs to trade the business, you can use that. You can use seller financing and also earnouts, which, as you know, are like bonus payments based on higher than anticipated future performance. You can leverage lines of credit if the business has access to existing facilities that it hasn't used. You can use asset-based lending. So you can leverage real estate, accounts receivables, inventory, IP, even plant and equipment. You can go raise equity. So for the sorts of deals that I do, it's more angel investors. And the benefit of an angel investor in a deal is not only are they bringing capital to the table, they're bringing knowledge and expertise, which as the new owner of a business, you can leverage as you improve the business in the market. Businesses in your lane, so that you're buying a business in an area that you can add some value to. So case in point, you're a sales guy for IBM and you want to buy a technology company. Great. The SBA are going to fund you. If you want to buy a vineyard, they're going to say, well, hang on a minute. That's not really in your lane. You would have to go and partner with somebody that knows how to run a vineyard. They want to make sure that the buyers, either as an individual or within the buying group, have got the chops in the industry. And whilst, you've got big federal guarantees backstopping a lot of this financing, the SBA, they're not stupid. They want to make sure that, you're doing the deal. Ideally, they want the buyer to be an owner manager. I've done SBA deals. I don't work in any of my businesses, and I never have. But what they want to make sure is that there's a solid number 2, or there's a solid general manager